and we know that it's hard to park. Wow. We know it's hard to park, so I am going to get started for those of you who aren't here, so we can get going. I know some of you have seen my presentation before, but I know you really liked it, so I'm going to do it again. And it's super fast. Okay, so first of all, I'm Cheryl, Lytle. My husband is Jeff Lytle. He's sitting in the middle here. We are husband and wife, mortgage loan officer team. We're both licensed, both originators. And we have today a super special guest that we never see, our regional manager, Jeff Radburn. Thanks for coming, Jeff. And our bestest, most awesomest setup girl in the whole world, Taylor, is here as well. So in this business, and let me, one more, Chris and Susan.
Yes.
Okay?
Hello.
They're with Elevate My Score. So this is really funny, I have to point it out. Jeff and I are married. Taylor and Jeff are daughter and dad. And these guys are brother and sister. Oh, wow. And it's a family-run class.
Family affair. We expect nothing less than Georgetown, right?
Pretty awesome. It's Georgetown, right? Work out.
Y'all know what SWBC stands for, right? Sisters, wives, brothers, and cousins.
That's good. I don't know if you just made that up.
I thought it was Southwest Bill Company. Or Southwest Baptist Church.
Any of those. So SWBC, Southwestern Business, is a corporation? Corporation, yeah, I always get it mixed up. Corporations. So I like to start off with, I've been in the business for 23 years. I've seen a lot of different kinds of deals. Jeff and I have been a team for the last 4 years. And we have our office here on the square, but before we start talking about all of that stuff, I'd like to introduce who we are. And so Jeff's going to run my PowerPoint today. He's going to advance that screen. Hello, welcome. So I know in the world of GCI and Photoshop and all that. CGI or GCI, whatever. That everyone gets confused. Can you advance, please? This is a real life picture.
What?
From 19. Oh, you can't see
Hey,
it.
turn the light off to see that one.
Oh, okay, let's see it.
Oh, high school sweetheart.
Okay, so in 1991, Jeff Lytle, Cheryl Owens to the prom. It was his senior year, my sophomore year. It was the best day ever. And then we went off and went to college. So we never saw each other again until, like, can you advance me? 3 years later, with the help of Facebook, right?
Really?
We had both gone on, got married, had kids, done that thing, and it's really funny how parallel our lives were, but I had gone back to my maiden name, and one day I was on Facebook, and I got this thing called a private message. Didn't even understand how to do it. It was that guy.
Yeah, that's right.
So then, maybe you got to advance me.
Tell me.
In June of 2015, so 3 years, right? 3 years ago, we developed the Lytle Mortgage team with a little help of Google domains, right? That was a $10 decision. And then we went to Las Vegas and we got married and made it official in 2015. It was so cool. Events. We went all around the world. Right? All of our entire wedding picture collection right here, ladies and gentlemen, selfies. Okay? That's it. So we went to Paris and we went to New York and we saw Pegasus and Greece. It was amazing.
Was this all in Las Vegas?
Yeah.
All in Las Vegas.
Yeah.
We've been around the world.
I've been to all those places. So I know.
Up and down the street.
That's right.
That's exactly.
Would you got married to Bellagio?
Where did we get married? Church of the Flowers? Chapel of the Flowers. Chapel of the Flowers. Yeah. Anyway, in June of 2017, so we're on our 13th month, we joined the most fantastic company in all the land, SWBC Mortgage. And I do not say that lightheartedly, you guys. It is really a fantastic company. It is a San Antonio-based and operated company. That's where they started. They have been around for 40 years. They are Texas-owned and operated, and they are a $4 billion company. And they service their own loans. Now, obviously, there are some bond programs they don't service because those are serviced by the bond servicer or Texas Vet by the Texas Vet servicer, but everything else we service. So it's an amazing company, and they have figured it out. Jeff and I did a lot of moves. Some of you have known us. Maybe no, I don't have to tell you guys this part anymore. We did a lot of moving for a little while because we couldn't find a company that would do the back-end support. We are only as good as our back-end support room. And so we love this company, and we cannot say that enough. We have the cutest little office on the square. Does that look familiar? Anybody from Georgetown? Yeah. Yeah. We are right next door to Burger University. And we have a cute little office space in there, we have a couple rooms, chairs on the outside, just really fun, and we love people to pop in. So if you guys are down here and around, come pop in and see us, because it's really fun. And then Jeff will even make you coffee. He's the best coffee maker. I added a slide to another presentation, I forgot to put it on this one, but we had a realtor, he makes it with whipped cream. I mean, it's really pretty coffee. And then this is our little office space. We really like working together, and I think our clients can tell that when we're in an office together, is that we'll talk with our clients and they feel comfortable in there. And that's one thing that we really like, is that face-to-face service. And so we can do all the Rocket Mortgage, do it quick, do it online. We do all that too for your techie millennials. I mean, we do that. But we also like to meet people in our office, because I think there's a lot of questions when people are buying houses, and people have questions, and we want to make sure that everyone, and I think eye-to-eye contact is the best way to make that happen. Go ahead. Okay, so this is what we do. We do mortgages, right? We can do purchases, refis. We have the renovation loan. So if you have a house that needs to be remodeled, talk to us. We have the 203K so that they can buy, you get paid, and then they fix it, right? And we have the home style, the conventional version. We have all of those products, and we have an entire team that takes care of those and underwrites those and makes sure that they get done quickly and in a good manner, okay? Next one. Oh, and before you do, I'm sorry, sweetheart. USDA, okay? How many of you have done a USDA closing, right? One, okay. When you get there and you do a USDA loan, they can be very tedious. They do not have to be. We did a USDA closing in 17 days, my third week here. I mean, it was insane. They are very good at it. They know how to do Texas because they're from Texas. So, okay, go ahead. When can I help you? I can help with purchasing, upsizing, downsizing, divorce, renovating, buying, needing repairs, getting a second home, investment properties. Anytime you hear I need a home loan, I want you to think of us, because we would be happy to help, and we can do it. Okay, go ahead. And if I can't, that's one thing that's different about Jeff and I. I pride myself in, if I can't do it, I'm not gonna say, oh, I don't know, sorry, next in line. Is I like to know my competitors, and I like to know what other people do. And if I can't do it, and there are some things that I can't, and I'm not gonna tell you what they are, because then you'll go, she can't do that. And maybe someday I will be interested. But if I can't do it, I will send you to a person that's just as reputable that will help your clients, and I'll tell you that I'm doing it. Okay? Okay, go ahead. Oh, think of us for your family, your friends, or yourselves. This is our domain. We are the Lytle Mortgage Team. So it's super easy, just thelytlemortgageteam.com, and we love mortgage. So for those of you who sat through it the first time, I hope you enjoyed it just as much as that. All right, do you want Jeff to talk next, or do you?
Jeff, yeah, have you got a few things?
Yeah, so I'll come up here so you don't all have to turn around. Again, my name is Jeff Redburn. I'm the regional manager. I have offices from Dallas all the way to San Antonio and on both sides. And the thing that I just wanted to say, when you think of me, hopefully I do get to visit with you guys. And the reason why I say that is I'm the one that gets to control pricing and things of that nature. So if y'all have something special or something that just fell apart and you need something done really, really quick, like a favor, one of those favor things, you never know who the person is to call. If you've got your cell phone numbers, or I'm gonna give you my cell phone number right now. That way, last minute, Jeff, don't you remember we were in the library at Georgetown and you said that you would help me out with something? This is, I'll remember, it's 254-495-9696. Here's what you would call me for. Hey, we just got notification from another lender that we're 2 days before closing and we can't get something done. Okay, I'm not saying we're gonna be able to turn around and close it in 2 days, but if we need to turn something around in 8 or 10 days, something like that, for a favor, for something like this, to show you, wow, they're gonna do whatever it takes to get our business, call me, that's what I'm here for. Or, hey, we just found out that their debt to income ratio was a little bit too high and they're not gonna be able to get into this house, and the moving truck's already showed up in the driveway, and you call me and you say, hey, can you do me a favor on a rate or something of that nature? So, to get your business and to show you that we are true partners with you, even if we have to lose money on one, we'll do that because we want to prove to you that we're here for the right reasons. So give me a call and say, Jeff, I need, pricing. Here's what I'm gonna do for today as well, okay? So this is for your next client, okay? Each of you, for your next client that you bring, I'm gonna do a free appraisal, okay? So just for showing up today, your next client, you get to look like a hero. You get to say, hey, I just happened to be in a class on Thursday, and you're showing them this weekend. Hey, I'm gonna give you a free appraisal for your next client. And Cheryl, it's kind of one of those trust things. Just pick up phone, call Cheryl, and Cheryl will make sure that that happens for you guys, okay? So just little things like that we can do to get the opportunity to show you how good we are. Because we know there's 1,000 of us out there, and we all make all promises and all that kind of good stuff. We want to show you that we are that team that'll do that for you. If you don't know much about Cheryl and Jeff, I mean, they are fantastic. So the thing that I love about them is they don't want to be that big guy up and down the street. They want to stay on the square. They want to take loans that come into them. They don't want to do 40 of them a month. I think they'd like to do 10 a month, something like that. But they're not gonna grow so big that they're not gonna give you that personal care. And that's, in Georgetown, I know you gotta have it. It's all relationship driven. For you guys, we represent you and we know that. So that's what they really are fantastic at. And that's why they're here. And that's why we recruited them. That's why we wanted them here, is because we wanted somebody that was gonna take care of your client the same way that you were gonna take care of it, if not better. Okay? So again, Jeff Bradburn, if you have any questions, pick up the phone and call me. I'm so excited that you guys are here. These two guys are doing a rocking good job. I do this up and down I-35, and we don't have this many show up to a lot of our classes. So thank you guys for being here. We know that you are wanting to learn and take care of your clients. But I'll turn it back over to these guys.
All right, thanks, Jeff. Hey, appreciate it.
You bet.
All right, so thanks guys for coming out. So my name is Chris Busch. I'm president, owner of elevatemyscores.com. I've been in the credit repair business for a decade, a better part of a decade, and helped thousands of clients get qualified for home loans. And you get to know so many people in the business. So somebody else that works under Jeff is another guy that was known forever, and through them met Cheryl, and then kind of reconnected with Cheryl when we were just out and about walking around Georgetown. So I've done a lot of business with SWBC over the years as well. Always good to do business with Texas-based companies. So I was born and raised here in Texas, sixth generation Texan actually. Grew up in Houston, went to Texas A&M, so I don't know if there's any Aggies in the room. And then happened to be very lucky to have an older sister who's much smarter than I am, who came on board to work with me very recently. So she is our regional director here in Austin. So you have her card. Any questions that you have immediately, she's gonna be your main point of contact here in the Austin area. Things that we like to do with realtors and with mortgage companies together is like home buyer seminars, things like that. So if you're interested in putting things like that together either with yourself or brokerage where you're at, we can certainly work with you and do any kind of home buyer seminars, anything to help you market and drive in business. We're here to help you do that. So Susan will be your point of contact with that. So.
I just wanted to welcome you to the library today and thank Cheryl and Jeff. I've been in the Georgetown area for 20 years, raised my family here, stepping away from my teaching career to work, go out into the business world, and I'm excited to help my brother grow his footprint of his business in the area. So I specialize in enrolling new clients and meeting with them, kind of being that trusted person for them to talk through that beginning stage of looking at their credit. And it's often a difficult situation to be in, where they were hoping to find that home and realize they had to kind of backtrack and fix some things. So I'm happy to meet with them and tell them how we can help through our program. And Chris literally has helped thousands of people, and he really enjoys building relationships and partnering with you and other real estate professionals. So thanks for coming today, and you've got our contact information, so please reach out if we can help.
Sorry, just going a little small there. There we go. And we don't keep coming back there every time I hit the button. So we're going to talk about how it's working.
Just block here, I can do it, what I do.
All right. Ding, turn the page. Just hit the space bar. There you go. Yeah, technology never works for me, it seems like. So what's in a credit score? How many people have actually taken the time to look at a mortgage credit report? Besides the loan officers. A little bit, maybe. You probably noticed there are 3 scores on there. Those scores were different. Did you notice that? Do you know why the scores actually score differently?
No,
No. Probably wondered why.
depending on yours.
Actually, yeah, because we recently purchased another home, and they were all, I didn't have a general idea of my own personal credit score, yet when I got the report, boom, boom, so explain.
Yeah, so it's kind of confusing when you look at it, like Experian, TransUnion, Equifax. In some cases, everything's reporting the same to the credit bureaus, but they have different scores. But there's kind of 2 reasons, really why things, scores might be different on the credit report. One is some things might not be reporting the same to each bureau. You may have a medical collection that's just reporting to TransUnion, and another collection or a late payment that's reporting to all 3. That may show some variances in the score. Other things where you think they are actually reporting the same to the credit bureaus, you may actually have a credit card company, let's just say Capital One, I pick on them a lot, not because they're bad, just because they're easy to remember. They may be reporting on different dates to the credit bureaus. You may have them reporting on August 1st and then to one bureau, and then on August 18th to the other 2. And whenever, and we'll talk about this, whenever you have the balance of your credit card, when they report it, it's a snapshot in time of what your balance is at that particular time. So if it's reporting on different dates, that can actually cause a fluctuation in your scores. But probably the biggest reason and the biggest part of the reason why your scores show up differently, and there are 3 different scores, is because of a big word called algorithms. Algorithms is a fancy word for mathematical formulas. So there's over 100 different ways to compute a credit score. So over 100 different algorithms or mathematical formulas across some different methodologies. Have you guys heard of the term FICO? Okay, probably on the news, whatever, or just in your dealings and being in the industry, you know what FICO is. But do you really know what FICO is? So FICO, can anybody tell me what it stands for besides the mortgage people in the room? Fair Isaac Corporation.
Fair what?
Fair Isaac Corporation. Yeah, Isaac's not very fair. So the Fair Isaac Corporation was started in the late 60s. They actually invented credit scoring. And they've ever since have been kind of the law of the land for 90% of all lending decisions are made using some kind of FICO-derived credit score. Okay, but there are other methodologies out there. Vantage, everybody heard the term Vantage with a V? How many people use their phones to show you your credit score? How many people look at your phones for a credit score? Do you? Anyone? Credit Karma, your app on your credit card, anything like that, where you look at it and go, oh, okay, there's my credit score? Yeah. How many people have used Credit Karma? Okay, 1 realtor, 2 realtors. So Credit Karma uses what's called a Vantage score, Vantage 3.0. Where did Vantage come from? Why is it important to understand? It's important to understand because you may not be using it, but your clients might be. The clients that you talk to might say, well, my Credit Karma on my phone told me my score was a 625, and now you're sitting here telling me that these guys over at SWBC pulled a credit report and it's telling me I'm a 590. Well, we need to go to a different mortgage company because they don't know what they're doing because that's not my credit score. My phone says it's a 625. Well, SWBC is right actually, and Credit Karma is right with their algorithm. It's just different ways to come up with a credit scoring number, okay? So the Vantage score, where it came from, the 3 credit bureaus got together in 2006 and they said, hey, we're gonna redo credit scoring. We're gonna come up with a completely different way to do credit scores. They called it the Vantage model. Experian was actually the ones that spearheaded the whole thing. Their intent was really to put FICO out of business, but to replace FICO scoring. So they were gonna come up with like a letter grade system where you're gonna have A paper, B paper, C paper type clients. But it didn't really fly very well because FICO's like, wait, hold on. You're gonna steal our business, put it outside of business, and by the way, you will now control everything, the algorithms, the data, all of that. So they sued, they won. So Vantage is not gonna see the light of day in any lending institution, but so FICO is still the law of the land in the lending industry. But what did they do with it? Well, they sold it out there on the internet very cheaply. So that's why places like Credit Karma, which is free, can use Vantage. But a lot of other credit monitoring companies and credit monitoring services use Vantage. Why is it important? Why am I talking about it? Because it's important to understand because your clients are gonna see scores a lot of times that are driven from a Vantage 3.0 scoring model. It's not that it's necessarily a bad thing, because a lot of credit monitoring services offer a lot of great services like telling you what's on your credit report, letting you know if there's a collection, letting you know if there's new things that come on your credit report. If someone steals your identity, letting you know about that because somebody's trying to use your credit report or your credit and you don't know it, and you get a message letting you know this. But at the end of the day, the score that they're seeing may not be the same, or it is not the same of what's found in the mortgage industry or really any other industry, okay? Now in the FICO world, there's actually 49 different FICO algorithms across 4 different industries, okay? Mortgage industry being one of them, the auto industry, credit cards, insurance. Now if you actually go to myfico.com, you will see a credit score that shows up. And also, if you pull up your Discover app, Capital One, places like that, a lot of credit card companies will show you a FICO score. I think even Equifax will show you a FICO score. But guess what? It's still not the same scores that Jeff and Cheryl will be pulling. It is a FICO 8 score, okay? FICO 8 is not a mortgage score. FICO 8 is actually probably more in line with the Vantage score. It's gonna be higher. The mortgage scores out of all the scoring models are typically gonna be the lowest scores you're gonna see, okay?
What I'm surmising from what you're saying is basically,
It's confusing?
no. Honestly, we are not, as just a regular general consumer, we are not gonna find an accurate score as accurate as.
It's accurate as the place that you're gonna go. So if you're trying to buy a car and you want a accurate automotive credit score, you need to go to Covert Chevrolet or whatever car dealership you're gonna go to and have them pull your credit. And that credit score at Covert Chevrolet is gonna be different than what Jeff and Cheryl pulled, okay? Because it's industry driven.
Okay.
The bank's gonna pull an algorithm that's based off of their models, okay? It might be a FICO 8 score that they're pulling, okay? Because I have seen some lending decisions where it shows that it's a FICO 8 model. But in the mortgage industry, they use mortgage-derived algorithms. There's 9 mortgage algorithms, but there's only 3 bureaus, so how does that work, right? So they're gonna use 3 of those 9 algorithms. Each bureau is gonna use one. They have ones that are kind of assigned to them or built for them, for that bureau. And that's the algorithm that's gonna be used, that's gonna show. Now, on the credit report, when Jeff and Cheryl pull it, it tells you what the algorithm is, the actual name of the algorithm, okay? Beacon 5.0, Classic 04, Fair Isaac version 2 are the 3 that are gonna show up on the credit report, okay? Now, those do make revisions, things like that, and those revisions kind of get, addressed, because I remember when I started in the business, FICO 02 was being, or no, Classic 02 was being used, and even Classic 98 was being used a lot under TransUnion, and even Empirica was another one that was being used, which is still technically a mortgage algorithm, but like Classic 98, Classic 02, and Empirica are no longer really used in the mortgage industry, but they're still out there as part of it now. But why aren't they used? Well, because the people that buy the loans, what are called the investors, the people with the money, have said, well, we don't want to buy a loan with a Classic 98, score or an Empirica, algorithm. So then what happened is everything got driven, and when they actually go and run it through DU, I think now DU looks for the right algorithms, is how it was explained to me. Does that sound right? So that's what it was explained to me, that's how it kind of works. But it's basically that you just need to know that if your clients want to see what their mortgage credit score is, the best place to go is a mortgage company for mortgage scores. But don't say, oh, okay, well, this is my mortgage credit score, it's gonna be the same when I go buy a car. It's not. Question?
And just out of those 9, just for, I guess, kind of closing it out in my head. So if we went here and they pulled the credit score, I could go over to a credit union, but they might be getting a slightly different one of those 9 algorithms. So I still, I could go to 9 different places potentially and have 9 different
If you go to the
scores.
same, it's a good question, because if you go to different mortgage companies, because the investors are the ones driving what algorithms are used,
Right.
all mortgage companies right now use the same algorithms.
Okay.
Didn't always used to be that way. When I got into business 10 years ago, I remember, there were like Wells Fargo. You went to Wells Fargo, you were most probably, or you would see a different credit score than if you went to SWBC. Okay, and there were different mortgage companies that they decided to use different algorithms. I even had an owner of a mortgage company put a client through my program because they used an algorithm that was outdated when they did the loan, funded the loan, put it on their wholesale line, but they couldn't sell it to the outside market because they said, we will not buy a loan with that algorithm. And because of that, when they rescored it, the score dropped. And it dropped the mid-score, and they couldn't get the loan done. So, again, those things don't really happen anymore because of the way just the market has gone.
Well, it's helpful. It's helpful to have that explanation. 'Cause
Yeah.
I think part of it's kind of that trust level to a client. And some people might be like, they're not willing to talk to the lender yet. They're maybe not ready.
Yeah,
to
and that's the
Because
big
like,
thing
I'm not
is-
good enough, but maybe they are, or they're hearing two
Just-
different things. Now I don't
just-
trust you because
Yeah, you're not,
touching my
this is
phone,
what I read
so-
on the internet, and
Right.
you're telling me something different. I'm like, oh no, you're fine, that Credit Karma score should be good, it says it's 620, let's go pull. But what I always say is engage with your mortgage lender even before they pull, so they get to know you. And I tell people that all the time that I'm talking to, they're like, well, I'm not ready to talk, even people that we have what are called orphan people where they don't have a realtor or a loan officer, they come to us and they'll say, well, let's get you partnered up with a realtor and a loan officer now, because having these conversations with them early on in your process, even though you're not ready for them to pull your credit report, is still good, because there's a lot of things you can learn from what they're gonna tell you as far as the underwriting is concerned of the loan that can help you. Okay. So yes, don't let them like, oh, I'm at a 580, I'm not gonna have them pull, but just because you talk to them doesn't mean that they need to pull their credit report. It's still good to get a relationship with them first.
Yeah, no, and I'm looking to kind of do that.
Yeah, yeah. So I think I beat this to a dead horse. Go ahead, Dean, turn the page. There we go. Mortgage FICO scoring model. We're going to talk about this model versus any others because this is the one that's most important to us because people are trying to buy a home. There's 5 different sections of the mortgage FICO scoring model. The first one being the payment history. It's 35% of your credit score. This is going to be anything that you're making payments on. It's going to impact this section. So your car loan, your home loan, your credit cards, boat loan, student loan, all that kind of stuff. Every time you make a payment, it gets calculated and improves this section here. Now, when I use the word trade lines, do you guys know what the word trade lines mean? Okay. So a trade line is a line item on the credit report. So if you have, let's say, going back to that Capital One credit card, Capital One is reporting to Experian, TransUnion, and Equifax. That's a trade line because it's reporting to all 3 credit bureaus across there. Now, even if it's only reporting to 2, it's still considered a trade line. But it's an item that is describing that particular item on the credit report. Okay. So I'll use that word a lot today, trade lines. Now, when Jeff and Cheryl pull up a credit report, on that trade line, there's a little box on there that says months reviewed. The higher that number goes, the more it impacts you in this section here. And as we talk a little bit throughout, you'll understand why, and I'll kind of come back to it, why that can be important. But the more payments you're making on something can impact your score in this section more positively. So people ask all the time, like, well, I have a car loan, I'm halfway through it, should I just pay it off? So, because I know if I pay off my credit cards, it helps my score, but paying off my car loan, shouldn't that, boost my score pretty high? Not necessarily. And in some cases it could hurt you because It scores based off of the number of payments you've made on that car loan. And that's how it's going to impact you here positively, okay? It's also where all your negative information shows up here in this section. Collections, charge-offs, liens, bankruptcies, etc., all are impacted in this 35% section. Now the next section here amounts to is 30% of your score. This is gonna be your revolving accounts. So again, let's go back to some terminology here. When I say the word revolving, do you know what I mean?
Accounts you've closed.
Accounts you
Credit cards,
closed.
like credit cards?
Credit cards, absolutely. It's a credit card. A revolving account is a credit card. So just like a revolving door at a really fancy hotel, you walk in there, you revolve around, and that's kind of what happens to your money on that credit card. You have a $1,000 Capital One credit card, you make a purchase of $900 of tires, and then you go pay it off. Well, you can borrow back against that again. So like a revolving door of using that card. Every time you pay it off, you can always go back and use it again. Now, if you have a car that you buy for $30,000, you pay on it for 3 years, you get it down to $15,000, you say, oh, I need a new set of tires. You can't say, well, I'm just gonna borrow back against that same trade line. You can't do that, that's not how it works. Okay, an installment loan, you have a set payment, you know, and the number of payments, so $300 a month, 60 months, you pay it off and it's done, okay? But you can't borrow back against that trade line. You can borrow against the asset, but that's different, not the trade line. The revolving is you're able to borrow back against that trade line. So other things that are kind of in, that are revolving are things like HELOCs and lines of credit would also be included in revolving. And we're gonna kind of talk about credit cards because that's the most important thing here and usually the most important thing that affects this section. The first thing to note is if you do not have a credit card, you don't score in this section. So that means if you don't have a credit card, you're only scoring in 70% of the model. So put a pin in that, we're gonna come back to that. After this, we're gonna talk about building credit, okay? Let's talk about what happens when you have a credit card. So when you have a credit card, it's scored based off of your utilization ratio. So let's go back to that Capital One credit card. It's a $1,000 credit limit. You buy a $900 set of tires, you're utilizing what percentage? 90%, okay? The higher that percentage is, the less points you earn towards your credit score. And one thing to note is technically, if you're at 90%, that's not negative. Okay, I know sometimes people have to kind of get that through their brain because they'd say, well, what do you mean? I mean, I'm losing points, how is that not negative? Technically, that trade line is still earning you points, so that trade line is not negative. When you put a negative on a trade line, that means the entire trade line is negative. You're still earning points on the trade line, on that revolving account, on that credit card. Because I hear people all the time, they'll tell me, like, I'll ask them, say, hey, Chris, or I'll say, hey, what's negative on your credit report? And it's like, oh, well, I got a bunch of credit cards that are maxed out. Well, your 90% credit cards is not necessarily negative. Those 10 medical collections you have on there, those are negative, okay? So it's still a positive account. It just means you're earning less points than you would normally earn by having a high utilization percentage. So it works like this: at 90%, you lose 90% of the points that you could potentially be earning towards your credit score. Let's just say theoretically, and it doesn't, but let's just say theoretically that credit card's earning you 100 points towards your credit score. And if you're earning 90% of those points towards, or if you're losing 90% of those points towards your credit score, what's that trade line earning you? 10 points, right? Now, if you pay that same card down to $300, well, now you're utilizing 30% of it. But at 30%, you're only losing 10% of the points that you could potentially be earning towards your credit score. So now how many points is that trade line earning you? The opposite. I know, you're like, I was told there would be no math. So 90 points, right? So yeah, so you pay it down to 30%, now that trade line's earning you 90%.
So that's a
Or
sweet
90
spot,
points.
30%.
It's kind of a sweet spot, but I tell people, look, if you really want to help yourself out, pay it down to $10. Now, one little quirk in the algorithm is paying it down to 0 doesn't give you all your points for whatever reason. We always tell people to pay it down to $10.
Makes no sense.
It makes no sense whatsoever. You'll learn a lot in the credit world. It makes no sense. But it's just the truth. And even the simulators and stuff that they use will probably never tell them to pay it down to zero. They'll always say pay it down to like $12 or something. But also at 50% utilization, well, you're losing 25% of the points. So even if you can get a card paid down to half of the limit, it's still going to help you. And that's one thing that's hard for people to understand, like, well, I can't really pay a lot on it right now, so I'm just gonna keep paying my minimums and just keep spending my money, whatever, because I can't make big chunks on my credit. No, it's not true. If you're 90%, get it paid down to 75%, get it paid down to 50%. It's gonna make a difference, okay? You're gonna see some points come back in your score. And that's one of the things that we work through with our clients is we put together plans for them to help understand what dollar amounts and what balances and to pay down on their credit cards, putting together kind of a snowball type of plan where we work on the smallest card first, get it paid down, and then start working on others. The next section here is your length of credit history. It's 15% of your score. Now this is gonna be an average of all your open and active accounts, both your installment and revolving. But the biggest thing to note here is that your credit history is an average. So there's a lot of things that come into that when we're talking about other sections in this, it helps us decide what needs to be done, and we always a lot of times come back to this length of credit history. Well, we want you to, should I add a credit card? What's it gonna do? Well, what's it gonna do to the length of credit history? Should I close down a credit card? Well, maybe. What's it gonna do to the length of credit history? All of that comes back down to the average, okay? So let's just say, for example, you have a credit card and you only have one credit card and it's been open up for 10 years. You open up a second credit card, let's say you go to Kohl's, they're like, oh yeah, I got this great offer, 20% off. You open it up, now you have two credit cards. What happened to your average?
It just got shot in half.
Cut in half, down to 5 years, right? Because it's an average, okay? But let's say you have 5 credit cards, all of them would open up for 10 years. And then you go open up a Kohl's card, is that gonna really hurt your average that much? No, not that much, so it's not a big deal. But then people ask all the time, like, well, should I close credit cards down? Does that hurt me if I close a credit card down? Have you guys heard that before? That sometimes closing your credit card can hurt you? Well, yeah, if you take your, if you have 5 cards, 2 of them have been opened up for 15 years and the rest of them have been opened up, for a year, well, closing down those 2 cards just because, Citibank pissed you off or something, and you close down those 2 cards that have been opened up for 15 years, and you keep the other 3, like, well, I just opened up these ones, they're kind of nice and new and shiny, I like them, I'm gonna close down these older ones, well, what's that gonna do to your average? Straight down, right? So you don't wanna do that. I've told people before, I'm like, I don't care how much Chase pissed you off. Keep that card open or you're not gonna get your home, plain and simple. Or I'll see people on the other side of it where I'll look at it and I'm like, that card you opened up in like 1993 and you closed it down last year, why would you do that? Oh, it pissed me off, whatever. Like, well, that's why you're not getting home today. That's why your score is a 473 and not a 673. It's that big of a difference, because even if you have negative stuff on your credit report and you've got long history average, it's not gonna affect you as much because that one card could be, with otherwise perfect credit, you could have an 800 credit score, So there's decisions that people make that this section right here, if they knew more about the average credit history, would understand not to make those decisions. And especially like with, people that go through Dave Ramsey and they decide to start paying things off and closing things down, they really hurt themselves here in this section, and it's a hard thing to come back from. It's hard to put 15 years of credit back, in your credit history. But can you do that? Is it actually possible to retroactively put credit history back into your credit? You think? It is actually. Anybody heard of what an authorized user? Yeah. So an authorized user is when you get added on to somebody's card as an authorized user, that credit card will now report on to the credit bureaus, and you retroactively gain all of that history that's on that card.
So you put your spouse on the card.
Put your spouse, put your kid that's going out to college, put them on a credit card. Maybe that credit card's 30 years old and your kid's only 18, doesn't matter. They're gonna,
Even though it's not an online card, 2 cards at 15 years or something like that, is how it gets counted.
But no, if it's 30 years old, they get 30 years of average credit. On there. So it's not split.
That 18-year-old would.
Mhm.
Yeah.
18.
I've seen it all the time where people have lines of credit on there that are older than them.
Don't give them the card.
Yeah, just don't give them the card.
Yeah.
Yes, absolutely. She knows. Yeah. Yeah. You don't have to give them the card. In fact,
name, don't mean they.
yeah, and it's the one thing that I talk to my clients about all the time, like, if you can get added on as an authorized user, I don't know, maybe they really, I don't know their family history, like, yeah, I talked to my mom, there's like, no way, you know, I'm like, yeah, but you're taking her 4 grandkids and putting them in a home from your little apartment, she's not gonna throw you on a credit card? No, she won't put me on a credit card. I'm like, wow, you must have really made some mistakes in your life. You know? But that happens a lot where, I'm talking to people and I can't help them, you know, just by adding somebody on as an authorized user. The story I tell all the time is a couple down in Cibolo, they had just gotten, I think it was like their 3rd marriage, and she had great credit. All of her scores were the 800s. Every single one of her cards were opened up in the 70s. All of them low limits, and he had like no credit whatsoever, just a bunch of collections. We got him added onto 2 of her credit cards, and his scores jumped 90 points in 3 weeks, and qualified just off of that alone, because he inherited all that history. Now, eventually, I was able to go in and remove all the negative stuff off his credit report, so his credit scores were, you know, pretty close to hers, you know, in the high 7s at the end of the day. But it was because of her credit history that helped him out. So, any questions about length of credit history? So the next section here, the next 2 sections are actually worth 10% of your score. The first one being types of credit used. Here we're kind of looking for a good mix of credit between your revolving and installment. So we usually like to see 3 revolving accounts to 1 installment. Now, does that mean that if you have 3 credit cards and you know you paid off your car 2 years ago, or you paid off your student loan 2 years ago, that you need to go out and buy a car just to have that installment loan? No, not necessarily, because I've had that question where the guy's like, hey, someone told me that I need an installment loan to help my credit score, and so I was gonna, you know, buy my daughter a car as she goes off to college to help my credit. I'm like, well, hold on, does your daughter need a car? Well, no, she doesn't. Then, I mean, don't buy it to help your credit score, because it's not gonna help your credit score. But if your daughter needs a car going off to college, then go buy it, you know, I mean, that's just life. That's a different decision, but if you're doing it thinking it's gonna help your credit score, it's not, because the length of credit history, what it's gonna do, probably gonna bring it down, and it's gonna actually lower your credit score by adding that extra trade line. Yeah, do you get a bonus by having a 3-to-1 ratio in this section? But the bonus you get in here does not make up for that length of credit history, okay?
For student loans, it's never just 1 loan. So,
I know, it's a lot.
right, so, but does it count as like 1 installment? Because I had quite the opposite of like.
No,
a credit
it'll
card
count
and
as
then
like
loans.
20 trade lines on there, or whatever it turns out to be.
Yeah, like
Yeah.
20, so it'd be like 20 installment.
Yeah, and that's the one thing where it doesn't punish you for having too many student loans. The algorithm doesn't, but it does punish you for having like too many store cards, or having too many financial accounts. But too many educational loans, it does not punish you for that.
Good to know.
Yeah, yeah. But if you have like, but I have seen where people like bounce around to different things, and because they've gotten in trouble with, you know, things go to the bed, so they were with Sally Maid and Navien, and then because they didn't pay or whatever, now it's with this, you know, Department of Ed, and it gets broken down, and a whole bunch of like 7 new trade lines. That could hurt you, because now you lost all the history from the account that you stopped paying or were in collections on, and now the insurance kicked in, so the Department of Ed now owns it, and it's broken down to all these different loans and whatever, and that can hurt you because of that, because again, everything's an average, so now you got 7 accounts that have like a 3 months history, and it brings down your overall average. So even though you have credit cards, you know, that have been open for 4 or 5 years, your average is gonna start going down. So things like that could probably hurt you. But I do actually recommend a lot of times people, if they can, you know, and we actually do have phone numbers and contact and step-by-step instruction on how to do it, to contact the Department of Ed to consolidate your loans into one, and that's usually more beneficial. because then you just have one trade line on there that you're worrying about. And a lot of times you can get it for a much lower dollar amount per month than if they're all broken down into 15 different items, so.
Is that difficult to do?
I mean, I'm sure it's probably a lot of paperwork and time on the phone, so. We don't do all the paperwork and the phone work for them, but we just give them the instructions on what to do, so. But the other thing too is I mentioned, if you have too many store cards, it can impact you in this section. So when Jeff and Cheryl actually pull a credit report, they're actually on there called reason codes or factor codes that factor into why the score is not perfect. And I've actually seen on credit reports before too many open store cards. So I had a client up in Dallas, she had 25 store cards on her credit report.
I didn't even go to 25 stores.
I know. This girl loves to shop, yeah. No, I teased her. I was like, "You live here in the Galleria?" And she was like, "How'd you know?" I'm like, "Wild guess." But she was paying them all on time. None of them were late. All of them had, they were like 50% utilized. But all of that on there was really lowering her credit score. She had some other issues going on too, but because of that, it was really lowering her credit score, and it was impacting her here in this section. So she had the reason code, too many open store accounts. So I helped her put together a plan to whittle some of these down. Going back to never close, you hear never close credit cards, but she was a case where she needed to. Well, how do we do that? Well, we keep open the older ones, we close down the newer ones. Again, going back to that 15%, I say I go back to all the time when I'm making decisions on what to do. And I say, well, how can we better impact that length of credit history average? So if we close down some of the newer ones, we're actually going to increase the length of credit history average and help her credit score that way, okay? Another thing that can impact you here is too many financial accounts. So a financial account can be just like a bank loan, but a lot of times you see them as like note loans or what I call float loans. So you go to like Sun Loan or One Main Financial, places like that where, okay, I just need $500-600 to make ends meet this month, but then you keep going back, right? You keep going back each month and getting a new loan or an additional loan. I had a client here, she had over 20 of them on her credit report, and there was a note on there that said too many open financial accounts, again, impacting her here in this section. The reason why she had it, I asked her, is like, well, what's going on? And she's like, well, I'm a teacher, I get paid once a month, and sometimes in the middle of the month, my kids want toys. So we need to learn a new word, it's called no. And then we need to stop the practice of going out and getting these loans every month. And she was like, yes, I know, I understand. It's a little bit harder to work with somebody like that than the person that has the 25 store cards, because it's not like you can just pay those off and not do it anymore, but eventually it's gonna just take time to kind of filter those out. But I've also had clients that have had some predatory practices from companies like One Main and Sun Loan and places like this, Tower Loans, where I had a client, they had like 8 or 9 of these on there. Again, they had a notation on there, too many open financial accounts. And what it was One Main Financial, the person there, the loan officer, told them, well, the more accounts that you have on your credit report, the higher your credit score is going to go. So if you want to improve your credit score, you need to just keep adding more and more of these loans. Totally false. I was like, you got a good chance for a lawsuit, but how do you prove it if it's not right, whatever? It's your word against theirs, but it's definitely a predatory practice by some of these companies. So again, it's something that educating the client, getting them to understand how those are not helping their scores, getting them to stop, and then letting those kind of filter out. Now the last section here is new credit. It's 10% of your score. This section actually has 2 different elements to it. One is, the first one is new credit, or anytime you open up a new credit account, you're actually gonna lose points initially for opening up the new credit account. Now one thing you have to understand is how the algorithms are built. They almost look at it as how an underwriter might look at things. So, like in the case of having too many financial accounts, the underwriter might look at that and say, well, if you're having to get a loan each month, just to make ends meet, Well, that means you can't really handle your finances, so it's gonna lower your credit score. But an underwriter might say, I'm not gonna give you a loan because that's what it looks like. And that's how the algorithms are built as well. But in the case of opening up a new account, the first 90 days, the highest rate of default happens in the first 90 days of all loans. Home loans, auto loans, credit cards, whatever. The highest rate of default happens in that first 90 days. And in the mortgage industry, they actually track that 90-day default rate, right? You know this, Jeff, I'm sure. Companies have gone out of business because they had too high rate of default in the first 90 days. Allied Home Mortgage, right? You've heard of them? So because of that, you can actually lose anywhere between 20 to 40 points initially for opening up a new account. That could be credit cards, home loans, car loans, but you get those points back over a period of about 3 to 4 months.
So like on day 91, it can start to,
I'm sorry, say
on day 91?
day 91,
Yeah,
yeah.
well, it starts
Well, it
to-
starts kind of trickling back
Okay.
up. Now, and we'll talk about this when we get to new credit. Sometimes it's necessary evil to start building credit. And in some cases, the fact that you added that particular trade line helped you so much that you don't really see a drop in your scores, but you will see your scores continue to go up over the next 2 to 4 months, because you get that initial impact from adding that trade line, but then because of that other issue we just talked about, the new credit starts going down, your scores go up. Now again, when Jeff and Cheryl pull a credit report, they're going to see a reason code. Factor code 14 says length of time since an account has been established, and that's what determines that there. And it's all based off of the months reviewed section. So go back to that little box that I told you about, the number of times you've made a payment. So that's why it's important for somebody that does establish a new account to start making payments right away, and to make at least 4 to 5 payments on there. Because sometimes, and we talked about this in the class I did this morning, people that just open a card and never use it and then maybe close it after a few months, that's not a good thing. I've actually seen it where people have done that. Maybe they made one payment on it and then they closed it down afterwards, and now even though the card itself is a year old, factor code 14 still stays on their credit report as like reason number 3, which means it's still impacting their credit score because that month's review never got beyond 3 or 4. So I always tell people, if you're gonna open up a credit card, use it for 6 months and then close it. So if you're gonna open up a credit card and close it, may not be advised to do that, but if you are gonna do it, keep it open at least 6 months and then close it afterwards. But now the other thing here that impacts your credit score and new credit is inquiries, which is probably one of the most misunderstood things in the lending industry for mortgages, is an inquiry and how it impacts your credit score. So I'm just curious, what are y'all's thoughts about inquiries and how they may impact your score?
Big hit.
Big hit, an inquiry?
So, I had this conversation today, so it does drop your score initially, but they can tell if you're shopping for a home loan.
Okay.
And so if it hits on the same type for like a mortgage loan within a certain number of days or
Mhm.
whatever, it minimizes the hit or something like
So
that.
shopping windows? Okay.
Is that what's called?
Yeah, I'm not gonna say I'm gonna agree or disagree, but.
No, I mean.
I try to get the information and then I'll kind of let you know.
And then some inquiries are hit worse than others, I've been told.
And there's a soft hit.
Soft hit
Yeah.
versus a hard hit.
Hard hit.
So let me explain that. So soft inquiries versus hard inquiries. A soft inquiry is a review pull.
Is a what?
A review pull. So that means usually, typically speaking, a review pull is like, you're with Capital One, they get that $1,000 credit limit. You put in a request to increase your credit limit. They're gonna do a review pull of your credit to see, they don't get a full shot of it, like Jeff and Cheryl would when they pull a credit report, but they just kind of get a basic overview of your credit to see if they want to give you that, credit limit increase. Credit card companies that you don't have credit with can do a review pull as well, just to kind of get you up or down vote to where they want to send you an offer, and that's a lot of times why you get those offers in the mail when you have good credit. And also what you can do junk mail opt out of that, but it doesn't impact your credit score. That was a myth a long time ago. Mortgage companies were doing that as a trick to supposedly get 15 points guaranteed. If you did junk mail opt out, it never worked because soft inquiries don't impact the credit score negatively or positively. So, but also when you go online and with credit monitoring companies and check your credit through Credit Karma, you know, Identity IQ, LifeLock, any of these, those are all soft pulls. So you can look at your credit at any time online, and it's a soft pull. Also, when you get information from the credit bureaus, when you request a credit report from the credit bureaus, that's a soft inquiry. So there's no negative impact to your score for that, okay? Hard inquiry is when you apply for money or credit, and that's where the risk comes in. So again, going back to the algorithms built off of what the underwriter is going to look at, and the underwriter looks at what? Risk. So it's built in there that whenever you put yourself at risk, which means I'm applying for money or credit, I'm putting myself at risk, it's going to negatively impact your credit score. So the an inquiry impacts your score about 3 to 5 points per inquiry for the first 6 months. After 6 months, it drops down to a point. And then for that first year is really where you see the impact on your credit score. After a year, it no longer impacts your credit score, but it does stay on your credit file for 2 years, the hard inquiry, okay? Now going back to what you talked about, shopping windows. Anybody heard the term shopping windows? Yep. Okay, do you think they exist?
Yep.
Do you think Bigfoot exists? Have you seen a UFO? No, I'm kidding. But it's questions all the time, like, does a shopping window exist? Well, technically speaking, yes, it does exist. In the algorithm is built in that if you go and shop a certain amount of time for a certain loan type, that is supposed to protect you, where all those loan types within a certain time period count as one. So if you go, and shop for 10 mortgages within a 45-day time frame, they count as one. You go around to 10 car dealerships on a weekend, they should count as one, technically speaking. But what a lot of times people see in the actual reality of it is like, well, I did all this, and my scores dropped definitely more than 3 to 5 points. So the story I always tell about this is I had a loan officer that came to me and said, hey Chris, can you tell me why my client's score dropped 35 points? All he did was go buy one car from one car dealership, financed through one bank, and his score dropped 35 points. The trade line itself for the car is not even showing up on the new credit report, which could have explained the drop in the score, but it wasn't showing up on there. The only thing you saw was the 14 new inquiries, okay? So I took a look at it, and I hadn't a suspicion as I knew why, but it was really where I learned the true reason why, because not all mortgage credit reports show you the inquiry type, but this one happened to show you the inquiry type. And of those 14, because he went there and they said, hey, we're gonna get you the best rate. We're gonna shotgun this information out to all these different loan companies, but don't worry about it. Those 14 inquiries, you'll be covered by a shopping window. But when they sent it out there, and of those 14, 4 of them showed up as auto. The other 10 showed up as financial. So they were coded differently. Financial does not have a shopping window. Financial loan, going back to kind of what we talked about, types of loan, are like note loans, bank loans, personal loans, things like that are all financials. A credit card can be considered a financial pull. There is no shopping window for that, okay? So of these 14, 4 of them showed up as auto, so they counted as one. The other 10 counted individually. So technically speaking, he had 11 inquiries hitting his credit score at an average of a little over 3 apiece, gave you 35 points. Boom, there's the reason why his score dropped 35 points. Is this wrong? Yes, it's wrong. How does it get fixed? Well, it can get fixed after the fact, and we can work on that. Now, how it gets fixed beyond that, that's kind of a bigger question that my surmise is that if you go to a bank that does a lot of different things besides just car loans, like if you go to Ally Financial, which is where he got his car through, which does a lot of different personal loans, they code them based off of what their most common loan is, which is probably a financial loan. If you go to Toyota Motor, well, what do? They just do car loans, so it's going to show up as an auto loan. Okay, so it probably only gets coded one time when it gets sent to the bureaus, based on the most common type of loan that they do. That's my theory. I don't know. It's just a swag. I don't know if it's accurate accurate, but the fact is though, it's a good illustration of how something can be inaccurate about an accurate item. And store that away because I'll talk about it here a little bit. Let's move on to the next page. So remember I talked about the pin. Let's pull the pin out. Let's talk about building credit. Let's go back to that pie chart. We don't have to go back, but just in your mind. So if we cover up that pie chart, 30% of your score, if we don't have a credit card, you're only scoring in 70% of the model. It means you're missing out on almost 1/3 of your score. So a lot of times when you see people in that mid 500 range or just have a few negative items on their credit report, a big reason why is because they don't have revolving credit. Maybe they've got a student loan or an auto loan, but that's it. Credit cards can be a necessary evil when it comes to buying a home. But how do you get a credit card when you have bad credit? I get that question all the time. It's like trying to get a job when you don't have a job. Well, that's what's called secured credit cards. When I say secured credit cards, do you know what I mean? No? Okay, some of you. A secured card is when you go to a bank, let's just say it's Capital One, you open up a savings account for $200, and then you ask for a credit card, they give you a credit card that's got a $200 credit limit on it. Now they're gonna hold on to that $200 in savings, they're gonna secure it, and then if you don't pay your bill, well then they're gonna keep it, right? You know, they're still gonna charge it off and ask for all their money, but they're also gonna keep that $200 security deposit. So it's just basically kind of like training wheels for the credit challenged, is the easiest way to explain it. Now, do you think that when you go to get a secured card, since you're putting your own money down, that they're gonna pull a credit report and see if you're worthy of getting a secured credit card? In most cases, yes. So I'll have people all the time like, oh, Chris, I don't need to worry about the one that you're sending me. I'm just gonna go to Wells Fargo. I've been there for 20 years. I'm like, well, they're not gonna like your 482 credit score. Oh yeah, that's fine, but Wells Fargo, I've been with them for 20 years. I know Nancy, she's my friend there, the teller. She'll give me a secured credit card, and they go there and they're like, denied. Like, well, why did Wells Fargo deny me? Well, because you have 482 credit score. They want to see scores in the high 500s. A lot of times the banks, but there are secured credit card companies that will give you a credit card and will not pull a credit report. So we recommend to a lot of our clients a company called Open Sky Visa. They do not pull a credit report, and it's pretty much a guaranteed approval. You got a job, you got a bank account, they'll give you a credit card. It's a $200 security deposit. It's like 17.3% interest rate, which is not bad, like a $40 annual fee. I mean, for a secured credit card, that's not bad. But I don't really care about the interest rate, honestly, because I want you to only use it very sparingly once a month. Get you a tank of gas, pay it back down to $10, and that's all you need to do anyways. Just get you a low limit credit card, nothing that you can get in trouble on. We recommend getting at least 2 to 3. If you have the means, get 3. I've had clients that come to me before, like, oh, well, I got a $1,500 secured credit card, but now I can't afford, I don't have the money to get a second one because I just got a $1,500 one. I put $1,500 of my money that this credit card company has. I'm like, well, I would have rather if you split that into 3 and got 3 $500 cards. Because that's going to impact your score more in this section and also in that types of credit use section that we talked about by having more revolving accounts, okay? Now, you don't need to go more than 3. Now, the other thing too to note is if you have 2 credit cards, or even if you have 1 credit card, you still need to make some decisions on do you need another one. So I'll have people all the time, well, they have 2 credit cards, do I need to get a second one? I've been told that getting a secured credit card helps. Well, the 2 credit cards you have been opened up for 6 years and then 5 years respectively, so no, you don't need to get a 3rd credit card, all right? Because again, going back to that length of credit history average, it brings it down, it's not necessary. But if those 2 cards you opened up 6 months ago, yeah, go ahead and get a 3rd. Or that 1 card you opened up 6 months ago, yeah, let's go ahead and get 1 or 2 more, okay? So we make all of these, we help kind of clients make the decisions on exactly what needs to be done as far as, opening up new credit cards, things like that. But people are always in a hurry, so sometimes when you tell them like, okay, get a secured credit card, but it could take 4 or 5 months, maybe up to 6 months to have a full impact. Well, I don't have 6 months. I'm like, well, I'm sorry, your scores are 503. It's gonna take time. And part of the time is building credit. And that's just part of it. Now, installment loans are important too when you're building credit. If you're building from scratch, people ask me what's the best thing to do, I'm gonna tell you get 3 revolving and 1 installment. But again, going back to if you've got 2 revolving credit cards and they've been opened up for 5-6 years respectively, do you need to go get an installment loan? No, it's not that important. It's not gonna give you that many bonus points opening up a new installment loan. But again, if you have 3 credit cards, they've been opened up in the last 6 months, yeah, I'd probably go ahead and get an installment loan. That's gonna be helpful. So, any questions about building credit? One of the things I would note also is if you go to creditcards.com, because it's no secret where I come up with these credit cards, creditcards.com has a little section on there. You click on secured credit cards and it gives a full list of secured credit cards on there. And it actually will tell you like which ones are harder to get and stuff like that. Question?
Where do medical expenses come in the pie chart?
Medical collections would be factored into that 35% section of payment history. So all negative items get factored into that.
So only if they're in collections, so
Only in
they
collections.
just have
If you're making
installment
payment,
plans.
unless you have like care credit, which if you go and get dental work done and you get care credit, that's a revolving account.
Mhm.
So that would get scored in both the 30% section, which is your amounts owed, and also in your payment history section as well. But if it's like an actual, if you broke your leg, but you couldn't afford to pay that huge doctor bill, even though your out-of-pocket expense was $6,000 of the $50,000 that it actually cost to put pins and stuff back in your leg, and you make a payment plan with the hospital of $300 a month, to pay it off, that is not going to report to the credit bureaus. Okay, does that answer your question? Go ahead and turn the page here. So let's talk about the negative stuff. The FCC did a study and found that 7 out of 10 credit reports have some sort of detrimental error. These are going to be things like identity theft and identity errors. Now, are going to be the most common. Identity-related errors are the most common form of detrimental errors on the credit report. But let's talk about identity theft first. Even though identity theft is up here and it's certainly very important to talk about, it's not as common as far as on the credit report. Identity theft is very common, don't get me wrong. But identity theft impacting the credit score is not as common as some people might think. Because there's a lot of times people get their identity stolen and it never impacts their credit score. It's still important that if you go through and you get identity theft, that you do a lot of things to prevent that, from showing up on their credit report, like filing a police report, maybe even putting a freeze on your credit report at the bureau level. All those things can help mitigate it happening, but when I talk to people like, oh yeah, my identity was stolen 6 years ago, I didn't do anything about it, there's nothing on their credit report that's, impacting it, okay? But there are times where they are. We work a lot of times with clients. I've got a client here in Austin. He's a big time commercial builder. They're trying to, buy a $2 million home, and there's some stuff on his credit report that's identity theft related. We've gotten quite a bit of remove, but there's a couple things that are sticking, and we're, gone through everything with them, and the next step is hiring lawyers. So, and I'm actually continuing to work with them on that next piece, because we got a lot of it cleaned up, but there's still some stuff that hasn't been cleaned up. And it can be a real PITA if it does end up on your credit report. But a lot of times we can get it removed in most cases. But let's talk about identity theft more. What is identity theft? If your identity is stolen for a financial gain, that is identity theft. Common forms of identity theft: mail theft, pretty simple, exactly what it sounds like. Someone goes to your mailbox, opens it up, takes the mail out. Now, most people have the lock boxes and stuff like that, but I've also heard stories of people backing into them or running them over and then stealing the mail. Crazy what people go through just to get your name and address. When I was young, all you had to do to get name and address is look at the phone book, but I guess they don't have phone books anymore, I don't know. But dumpster diving, pretty much exactly what it sounds like. People diving into trash looking for your personal information. Pretty simple, buy a shredder, shred your personal information before you throw it out. Especially anything that has a social security number or any kind of credit card numbers, things like that. Shred that before you throw it away. Pre-texting, not something you do before you text. It's actually where know a little bit of information about somebody and you use that against them. So now that I know a little bit about Jeff and Cheryl, I could call them up and say, hey, I know you guys were high school sweethearts and got married in Vegas. I had a few questions for you. You know, the Chapel of the Roses, that's a great place. I've been there. Now I know a little bit about them. Now I can get some more information. Now, hey, go ahead and give me your credit card number, Cheryl. Oh, great, yeah. No, but it's getting some information about a person first and then using that information against them to get more information out of them. Shoulder surfing, pretty simple. It's basically just looking over someone's shoulder and trying to steal information. You know, so if you don't cover your information up at HEB or whatever, and people steal your PIN and bump into you, steal your wallet. Now they got your PIN, your wallet, everything. Fishing, so that's something we like to do on the lakes or rivers here. It is pH fishing, which is really trying to get information from you from like an email that might trick you into putting information in there. Like if you have an email that gets sent to you like, oh, click here to reset your Gmail settings. You click on the link, you go sign into Gmail. Now they got your username and password and they can get into it. It's a lot harder now than it used to be because most people now have two-step verification turned on. If you don't, make sure you have two-step verification turned on your Twitter, your Facebook, all your social media stuff, and especially your emails. Some other things that aren't up here, skimmers is another thing that kind of is in the same realm where people can skim and get your information from a credit card by putting a skimmer on a gas pump. And the other one that's not up here, but is also very relevant, is breaches. So not much you can do to prevent a breach in Equifax to happen, but when it does happen, you just need to be diligent about following the steps, and you might have to put a block on or something like that at the bureau level. Now, going back to, we talked about credit monitoring, I do think it's important to always monitor your credit for these very reasons. So if you go to our website, we actually have a credit monitoring service that we partner with called Identity IQ. All of our clients that enroll in the program enroll in credit monitoring, and one thing that they offer is $1 million of identity theft insurance. So not only does it help you see what your credit scores are and what's on your credit report, but if someone steals your identity, they'll cover you up to $1 million to get it fixed. And so those kind of things are important as well. And I've got clients all the time that will send me screenshots or email me or call me about like, hey, it looks like my credit report was pulled and I didn't do it. And it's like, okay, well that's an inquiry on there that's invalid and we need to go after it to get it removed. So, identity errors. Identity errors are actually more common on the credit report than identity theft. So identity errors, like for example, same last name, same zip code. So Johnson, Smith, Jones, Gonzalez, Lopez. If you have a last name that's very common, a lot of times you're gonna have things end up on your credit report that don't otherwise belong to you. And where we see this most is especially here in Texas or areas where just you have a lot of common names in a certain area. Like I had a client out in East Texas, his last name was Jones, and he had 5 tax liens on his credit report, and none of them were his. And when he called the tax office, they were like, yeah, well, I don't know what to do about it, but yeah, they're not yours, but we got it removed pretty simply. But that's something that if, Jeff and Cheryl pull it up and they see 5 tax liens on there, like, oh, you're not getting a loan. And they have to go through a lot of steps to try and prove that it's not theirs, but getting it removed from the credit report is probably the easiest, especially if it's not theirs. Now this one is kind of more obscure, but definitely more common than you might think. If 4 letters out of your name match with 7 out of the 9 social security numbers, then your files can actually merge. The story that I tell about this all the time is my Roberto versus Robert story. So a guy by the name of Roberto thought that a guy by the name of Robert had stolen his identity and opened up a bunch of stuff in his name. Now I knew the answer before I even went through it all because I looked at the credit report and it told me what I needed to know, the mortgage credit report. But I went through and I started asking him like, okay, what stuff isn't yours? And there was definitely some negative stuff, some medical collections that were on the credit report that were not his. But one of them that kind of jumped out at me was like, well, and he said, oh, and this Chase account. I was like, are you sure this Chase credit card is not yours? He's like, nope. He opened up that Chase credit card in his, you know, he stole my identity to do it. It's like, well, that's weird, because that Chase credit card's got a $3,500 credit limit, $500 balance, been opened up for 7 years, never been late a day.
That's good.
Okay, yeah, it's actually your best trade line on the credit report.
Yeah.
Okay, so this Robert guy is the most honest thief in the world, because he opened up a line of credit and then he's making all the payments for it. Well, it turned out poor Robert did not steal Roberto's credit, identity. On the credit report, as you guys probably know, it will tell you if there's a social security number mismatch, and there definitely was, and it said it right on the credit report. 8 out of the 9 numbers matched, and they just happen to have pretty much the same first name. Okay. But I've seen that, several times where that happens, but it is an easy problem to get fixed. Other things that can be identity error related is like juniors and seniors. So John Smith Jr. and John Smith Sr. could have, things cross-reporting on the credit report. Go ahead, turn the page there, Jeff. So what kind of negative items you see on the credit report? Collections, bankruptcies, charge-offs, inquiries, foreclosures, repos, lates, medical collections. These are all things that are negative. They can impact your score. Going back to, it all gets impacted and scored in that 35% section. Go ahead, turn the page here. So let's talk about collections. This is probably going to be the most important thing to talk about and understand of the negative items, especially for your clients to understand, is the collections and how they impact your credit score. So let me ask this question, I ask it all the time. Does paying a collection, and mortgage people stay out of it, does paying a collection remove it from your credit report?
No.
No.
Okay, you know that. A lot of realtors.
Did you hear all of that knowledge
Emphatic.
and experience?
It was like, whoa, I was blown back with that knowledge. Yeah. But I'm always amazed, when I do my home buyer seminars, a lot of times the answer is yes, then some real estate places the answer is yes. But the answer is definitely no. Paying a collection does not remove it from your credit report. Now, does paying a collection improve your credit score?
Yes.
In most cases, no. Yeah. Can paying a collection drop your credit score?
Yes. Is it a unit? Shouldn't drop
In
it.
some cases, yes.
Really?
Yeah. The reason why, new versus old collection. So the older a collection is, the less it impacts your credit score. The newer the collection is, the more it impacts your credit score. So old, less, new, more. And the reason for that is the date of last activity. The older that date of last activity is, the less it's impacting the credit score. Now, if you make a payment on it, what is that?
That's new.
It's activity, new activity, right? So it renews the date of last activity, even though the dollar amount is zero. The dollar amount with most collections does not impact the score. Okay, so you'll have that where people will go and pay old collections and then their scores drop. So again, going back to all my stories, the story of a poor lady, single mom down in San Antonio. She had 3 kids, getting her life together after a messy divorce, and saying, found a home of her dreams. She was 3 weeks away from closing. Got a call from a very, very bad individual at a collection agency for a medical collection that she knew she had. They said, hey, I just want you to know you cannot close on that home loan in 3 weeks if you have a medical collection. You know that, right? She's like, no, I didn't know that. Well, yeah, and so what I'm gonna do for you though, because I'm a nice person, is I'm gonna make you a deal. Instead of $800, you can only pay me $400 today. You pay me $400 today, we'll get it taken care of for you. She's like, okay, yeah, I've gotta get this home, it's for my girls. She did, she paid it. Her credit score got 50 points. But of course, we all know that mortgage companies don't care about medical collections as long as the score is okay. But so she lost the home. Her scores went from like a 640 to a 590, and at the time it was 520. It was 620 or bust. So, but I got it removed like that. I mean, it was like no problem getting it removed, and got her back up and even higher than she was, and she got another house. She got the loan, but it was, the point is, paying that old collection renewed the activity, lowered the credit scores. I got countless other stories. Another lady like, oh yeah, I just paid off all my collections. Is that why my scores dropped 90 points? Yep. oh, okay, you know. But it's important to understand the reason why I bring this up and illustrate it is because I hear this also from clients that we're talking to, like, you know, Chris, I don't need your services. I'm gonna do this on my own. Well, what does that mean? I'm just gonna go pay everything off that I owe. All I have is a bunch of old medical collections that are like $30 to $50. I'm just gonna go pay those off. I can do this. I don't need to pay you any money to do what I can do myself. And then of course they are flummoxed when they find out that they've gone and paid off all their old medical collections and their scores are even worse than when they started. So you just gotta be careful about doing this and, you know, talk to professionals. You've got, you know, great professionals in this room in the mortgage industry that know this stuff. Get them over to them first. A lot of times they can do a loan even with collections on there. You know, they can get things done without ever even talking to me. So get them to your mortgage professional first, have them take a look, talk to them about the situation, and see what can be done. Sometimes they can do things to help raise the score without ever even talking to me, okay? So that's why I always say, have your clients seek professional help. Don't get on the internet, don't start reading things on Reddit or whatever. Seek a professional that knows what they're doing, and these guys definitely do. Or you can send them over to me, or have them look at it first, and then if they think they need my help, they can then send them over to, you know, Susan and myself. Any questions about collections? Are you guys shocked a little bit on that one?
Makes sense now, but
Yeah, it makes sense now. And I guess the thing that makes sense about it when you look at it, again, we're going back to that risk factor, the underwriting decisions. Well, what is a collection after it's been paid? It's a historical record of your behavior. And that's why it stays on their credit report. And that's why it shows up like that. So, good or bad, whatever, but we understand, you just have to understand what it is and make sure the client gets the right help. Next slide there. Okay, this is where I'm gonna bring Jeff and Cheryl in a little bit to talk about the impact of credit on buying a home based on loan type. Now, the one thing we did not put on here is USDA. I know you guys talked a little bit about USDA, so Jeff and Cheryl, Cheryl, I don't know who wants to take this part. You want to talk about the different programs that you have based on, and the credit scores that you look for based on the types?
Sure, yeah. Scores, FHA, credit score, we're looking for a 600. VA, we're looking for a 600, but we like 620 because there's a little price break there. And conventional is 620.
Okay.
Is that what you asked before?
Yeah, yeah.
Okay.
Now, as far as conventional is concerned, I mean, obviously 620 is where you want to be at, but if somebody's a 620 borrower, are you going to put them in a conventional loan, or would you steer them more towards FHA?
I don't steer. That would
Not
be
steer,
illegal.
that's a bad word, I know. that term came up. Point them in the direction of.
Yeah, how I like to work is I like to show them, there are some first-time homebuyer conventional programs that are kind of cool, and I'll show them conventional, and I'll show them FHA, and then they can choose. You know, it could be the conventional is the better option because that MI insurance is not forever, but on that lower credit score, it can be a pretty substantially high percentage. So it just depends on that particular borrower and where they are in the world, what they choose, but I will show them both options, definitely.
Good.
And sometimes FHA is the better pick.
Option.
Yeah. Yeah.
It's usually a better payment,
Yeah,
which is
Yeah.
usually what that customer's really wanting.
exactly.
Could you, what was it again for FHA, VA, and conventional?
Sure, FHA is 600, VA is 600, conventional is 620.
We do allow for those 800 credit scores as well. just
We
for-
love it.
Yeah. Now, is there any difference between a 760 and an 800 when you're trying to get a conventional?
Not with us. No.
No. The answer is no.
760,
Yeah.
800, yeah.
But yeah, there's really no difference in any lending industry between an 800 and 760. It's a common question.
Yeah.
Now, one thing I like to always point out about conventionals, it typically does require a higher credit score, but you know, sometimes you can get a better rate, right? Based off of the higher the credit score, you're gonna get a better rate. At a 760, you're really not gonna get much of a hit at all. But at a 700, even though you have a good credit score, you're gonna take a hit on the scores. Now, I have several loan officers that will, especially if they're building, you know, people that are, you know, in the process of building, maybe they qualify that for that conventional, they're at a 700 credit score, they come to me, we work on getting some things cleaned up off their credit report. Maybe some of those old medicals, we get them cleaned up, get their scores up above that 740, 760 range, get them that better rate. So there's different things that can happen that we can work on with clients on conventional loans, especially. That doesn't have to do with just qualifying yes or no.
Is there such a thing as a perfect score? Like, is there? Like
850.
Oh.
No, nobody has an 850, no, put
Yeah.
that.
Going back to the Sasquatch thing.
Highest.
Yeah.
That would be the top.
Yeah, no. But actually, the thing that it takes to get a perfect credit score is, let's see if I can remember this, is at least 25 years of having at least 2 credit cards with an average of 25 years average credit history, and 1 mortgage loan that's at least 75% paid off, and then no other negatives and no other inquiries on top of that.
You forgot about the double backflip, the ring of fire.
Yeah, exactly. I've only one time, the best credit score I've ever seen was an 837. It was a gentleman that was the father of a loan officer out in Marble Falls, and he had an American Express card and a Shell card. Like, one was opened up in like 1963, the other one was opened up in 1967, and they had a mortgage loan that was like 75% paid off, and that was it. And he had an 837. Wow. That was in the office one time up in, and actually it was Allied Home Mortgage, way back when they were still around. But I was in their office up in Dallas, and there was an underwriter there, and she's like, oh, I got an 850 credit score right here. I was like, I don't believe you, show me. She's like, legally I can't show you this credit report. And I'm like, come on, just show me the score, just lift it up and show me the 850, because I don't believe you. It's like saying you have evidence of like Bigfoot, you're like, but I'm not gonna show you. Come on.
Yeah.
Go ahead and turn the page. So that's it. Do you guys learn something?
Yes.
That was it.
So if someone comes to you, I've had this, they say, well, I'm looking to buy a home in a year or so, but my credit's not the greatest.
Mm-hmm.
I mean, I right then steer them towards someone like you. How long
I mean,
does it take to?
It really depends
raise?
on, it depends on their particular situation. Every situation is different. I would say our typical client is with us about 6 months. Sometimes it can happen certainly sooner. Sometimes the client needs to happen sooner. But sometimes, obviously the more time they can give us, the better. But I would say the average client is with us about 6 months, but we definitely get people done sooner than that. But we get a lot of clients that are like, 464, like, okay, well, I got a client right now, he started, he was a 464 4 months ago, and now he's like at a 580. But he's still like emailing me every other week, like, are we there yet? Are we there yet? Are we there yet? I'm like, it's been 4 months. I told you this was probably 18-month progress, and we've gotten you up this far so far,
Can I ask your rates? Because I know that's gonna be a huge question of the client.
Yeah, absolutely.
You hear about it's a fixed my credit and they get locked in forever and nothing.
So we don't have any kind of contracts or obligations.
Okay.
And that's actually per Texas state law. You can't lock them into any kind of contract or obligation. But we have plans as low as $50 to get started. We have other plans that are a little bit more expensive, depending on what their needs are. But just for example, our standard plan, which is probably most comparable to the standard services out there in the industry, like Lexington Law, creditrepair.com, even though it is better because of the credit coaching and stuff that we give to the client that they don't get from other people like Lexington Law, etc. But that one's with the discount that the client gets, it's normally $100 to start. They get a $50 discount, they pay $50 to start, and then $70 a month. That $70 a month includes their credit monitoring as well. And it's a cancel anytime program. But most of our clients will choose probably our Plus plan, which is our most popular plan. It's our middle of the road plan, not our most expensive, not our cheapest. That one's normally $200 to start. They get a $50 discount. I mean, it's $150 to start and then $120 a month. The thing is, it's the Plus versus the standard. It's going to be twice as aggressive as far as the number of items that we're going after versus the standard. But it's also detailed, meaning we treat everything separate in the Plus plan. So we go after medical collections differently than we do late payments versus inquiries, things like that. So it's,
is there somebody that's challenged, right, that's a lot of money still, right? sense. Is there like any sort of guarantee that if I do everything you say to do, that I'll get?
I cannot legally guarantee, you know, like, hey, we can get you there where you need to be, you know, because I could if I gave a legal guarantee and then they did something like miss a payment.
Well, right, well, I'm
Yeah.
saying, if
Yeah.
I'm doing everything you're telling me to do, like, to a T on the game plan.
Yeah, and I still can't legally, it's like a lawyer saying, oh, yeah, I guarantee I'll get you off this DUI, they can't do that.
Okay. No, I'm just
Yeah,
trying to
so,
figure
but
out-
what I do is a warranty, so if we work on a client's file for 12 months, we can't get them up 100 points,
Okay.
then we'll refund them money, so.
That's good.
But, I've never had to do that.
So
I mean,
locally-
that's helpful, right?
Yeah.
So locally, Mike, if I need to have a claim, they're gonna call Susan.
Yeah, they're gonna talk with Susan.
Okay.
Yeah, I'll probably still talk to them, you know, at some point as well, and get involved in the file, but the main point of contact at first is gonna be Susan.
Yep.
So, but what I would recommend is, if you have somebody that's looking to buy a home, even if they're challenged, have them, you know, get a conversation with Cheryl and Jeff first, so they can kind of go over it, maybe they can help, you know, if it's somebody that needs 5 points, on their credit report, you know, they're 595, and maybe Cheryl can look at it and be like, do this, and we can get that loan done without ever even needing to come to us. So, Cheryl, what were you gonna?
I'm gonna ask, you mentioned about the woman that paid the medical collection and you got it removed. Is it normal that you can get a medical collection removed that's been paid, or is that something that was different for her?
No, yeah, we get paid stuff removed, probably in most cases easier than unpaid stuff.
So when I have a client and I'm looking at a score analyzer and it says, if they delete the account, then their score will go up this, but if they just pay the account, they're only get 3 points.
Yeah.
So if I tell them to pay it and then they came to you, then you can get it removed, is that right?
But in some cases, I can get it removed without them ever having to pay it.
Oh, wow. Okay.
Especially medical collections, because medical collections are governed by HIPAA. So a lot of times, information doesn't go from doctors and hospitals over to the collection agencies because of the HIPAA part of it. So when we start asking questions about that particular item, we usually have a pretty good success rate of getting it removed from the credit report.
Okay.
So, especially medical collections. But there are cases where we'll look at something and say, oh yeah, I just know. Like First Premier is a good example. First Premier credit card, probably one of the most charged off credit cards you're gonna see on a credit report. One thing I know about them is that, you know, a lot of times you'll see it's a $300 limit, now they owe $456 on it, and it's 150% utilized. Well, it's impacting that 30% section at 150% utilization, so it's hurting their credit score rating in that utilization section, okay? But I also know that First Premier, when you challenge it, they will not remove it if there's a balance on there. But I also know they'll take about a 20 cents on the dollar settlement offer. And then once it goes down to 0, 90% of the time, they do not respond to investigations that we send out. They don't want to answer questions on something they've already been paid for. And they take such high upfront fees that just as long as they get something off of it, it's like they don't care. So that's a good example of something I'll see First Premier. I'd be like, go settle 20-30 cents on the dollar, and then let me know once it's done, and then we'll challenge it, and high chance we get it removed. So that's kind of all part of the credit coaching process that we do. So, question?
So I'm working with somebody right now, that, their spouse has a lot of medical debt. So after paying something off, they were advised by someone in the mortgage industry to pay these things off in a certain order. So after paying something off, how long does it generally take to reflect on your credit report that you've taken care of a debt?
You know, it kind of depends on how quickly they report to the credit bureaus on that particular item. So there are times where people say, yeah, pay these things off, and depending on what it is, it may depend on how quickly it reports. If you're paying off like a credit card that's got a balance, it's open and active, well, it's gonna report the next time they report to the credit bureaus. But there are times where collections may report right away, and other times where I've seen it where, like, I'll see a collection, and I'll say, oh, I paid that collection, you know, 3 years ago. And I'll look on there and they're like, well, the reason why it still shows that balance is because they haven't reported to the credit bureaus in 3 years. So it may never report, you know.
And that's how you go in and.
And a lot of times, if I see that, like that one, and then when I'm thinking of it, came right off, because we challenged it. So one thing is, I know some people might leave, I just wanted to point out, if you liked what you heard today, please, go out and give me a good review. Not really a review of my services, just a review of the class, to let other realtors know that it would be good for them to stop in and take place in their Credit 101 class. Facebook, Google, Yelp, all the above are great ways to give me a good review. Any other questions, though? Great questions, and if you do have clients, please don't hesitate to get them over soon. Did everybody sign the sign-in sheet?
No.
Okay.
Take a cookie with you.
Please.
Take it to your children, your grandchildren, take it.
So with the free